And then that way you can invest that money that they put away on an annualized basis into other vehicles to keep growing the money.
Hello, everyone. My name is Freddie Rappina. I am a financial advisor, founder of Opta Financial. Welcome to our podcast. Our podcast is called Chess versus Checkers. And in this podcast, there's going to be discussions with a lot of different people on different areas of finance and wealth building. The goal of these podcasts is to differentiate between what I call checkers, which is the things that the traditional financial planning or traditional finance of saving money and all that stuff. And then chess, which is how do you build wealth with the assets that you have. The information in this podcast is not meant to be specific financial, tax, or legal advice, but we hope you enjoy the podcast and get something out of every episode. Thank you.
What happens to the value of a car after 3 years?
It goes down.
Goes way down, right? Massively. In fact, I think with all the debt that's out there that's coming due in the car business, car industry, we're going to see a massive devaluation of car values the next 24 months.
Well, we're seeing it used like the standard loan was like 5 years, and now it's 7. It could be even more years on the loan. Like the car's going to depreciate very, very quickly and within that amount of time. So yeah, that's. And there was also a few years ago there was a specific car that I know of that you can say it if you want to. That was purposefully made to be 1 pound over that limit, so it would be able to have that that tax related issue. It is kind of I would say like just a misconception that like you buy a car and for your business it's all going to be hunky dory with taxes, and that's usually not the case.
That's right. That's right, Freddie. There are many manufacturers that when you look at the gross vehicle weight of a car, it'll say they weigh 6,001 pound or 6,032 pounds because they're trying to get over that 6,000 pound limit. So that way it'll encourage those business owners to buy the cars
Right.
to get the tax write-off. But you and I know that sometimes it's better not to buy a new car. We're better off taking that money and buying real estate.
Well, if you're gonna, I've talked about this a couple times. Financing a car is not a terrible idea as long as you have bought an asset first to cover that payment. So you bought the piece of real estate that's going to create rent. That rent is going to cover the payments on the loan, the auto loan for the car. Now, after 5 years, the car's still going to appreciate, but you didn't make the payments, somebody else did. And now all your money that you worked hard for is now sitting in that piece of real estate where you can either continue to get that payment or sell it. It's just the concept of covering a liability with an asset. But a lot of people don't do that. They just simply finance the car and they use their regular income to make the payments. And over a certain amount of years, there's going to be not much of a car value, and all the payments they made is now sitting in a bank somewhere, no longer in their possession.
That's right, Freddie. And the other point I want to bring up is in the tax code recently, the Congress has legislated that you could buy a used car now to get the same deductions. You don't have to buy a brand new car. So you could look for a used car that makes sense to take over the payments and get it financed, where you don't have that substantial depreciation on the loss of the value of the vehicle. That way you could be more effective with the dollars you're spending.
Yeah. I said it to you earlier today when people ask me like, what book should I read on, investing in the market? I always say like, hey, it's okay to buy a book or, try to figure that stuff out, but buy a book on taxes first. Read a book on taxes first, because taxes is just, it's like your biggest cost, and there are plenty of ways to legally lower your tax bill. You just have to. You may have to do some things you may feel uncomfortable doing or don't want to do, but those things are going to help in the long run. And of course, listen to our podcast. We love real estate. We love the market too. Of course, that's where our firm makes a lot of money for our clients. But it's. The tax benefits on real estate they're hard to beat.
They're very hard to beat. In fact, if you plan strategically, your wealth can mushroom quickly. It's just about proper strategic planning to plan accordingly with how you buy or where you buy. And then the big question we talked about earlier is how to refinance the asset, right? And how to leverage that money to buy additional parcels of real estate.
Right. Yeah. The refinancing the real estate to buy more real estate. It's called the snowball effect, and it's compounding. Right. It's compounding that wealth using debt. You got to be comfortable with that debt to be able to then to do things like depreciation and cost segregation, everything we spoke about. But I'm one of the few financial advisors I feel like on the planet that says I love debt.
Yeah.
Just the right kind of debt, using it correctly, using it strategically, and having a team, having people that are going to help guide you and not try to do it all by yourself. And that goes with financial advisors, tax professionals, realtors, mortgage people, all of that. So it's a group effort to really be able to help people. But this is good.
And then, like you said, talking about debt, it's important for folks to understand that if you have 3, 5, 4, 6% debt, and you're buying assets, you're earning 10, 12% on your return on equity or cash flow, cash and cash return. That makes sense.
Yeah, that's when you're not. That's the problem.
That's when you're not. It's the problem. And then also, when you buy those new buildings, you could conduct a cost segregation study, so that way the losses from that new purchase could potentially offset against your other sources of income.
Yeah. It's really, it boils down to, again, knowing the rules, right?
Right.
The rules are set. The game is set up to win. Everybody wants to, just kind of dump on the Internal Revenue Service Code, but I see it more as a guide, more as like, okay, this is the playbook.
Yep.
To be able to keep more of the wealth. So it's like, okay, I feel like the government's saying like if you do what I want you to do using this playbook, you get to keep more of your money. If you don't do these things, that's fine. It's a free country, but I'm going to take what I need from you because I need to build roads, schools, and everything else that government needs to do to function.
That's right, Freddie. You hit the nail on the head. The Internal Revenue Code is exactly what it is. It's a code of rules and regulations. And so when you understand those regulations, you can plan accordingly and still become very, very wealthy. And it's just a function of planning ahead rather than planning after the fact.
Yeah, let's talk about planning. Okay, so in my opinion, there's a difference between tax planning and doing taxes. All right. That's right. So even tax professionals, like if your tax professional is not doing tax planning, they're just doing taxes. And that's likely going to be when there's no way of changing anything during the year. So you work with somebody that's going to help guide you throughout the year and give you options to make some good chess moves to be able to lower your taxable income. It doesn't, you may not get hit as hard at, come April 15th of the following year.
You're absolutely right. In fact, we at our organization, Robert Holland Associates, we have a tax planning service where we could plan and give you a 40-page report on how you could save more money on your own personal tax profile as well. Yeah. So there's plenty of loopholes in the system. And they're not really loopholes; they're just rules and regulations.
See, that's what I say. Like everybody likes to throw out that word loophole, like it's like it's free, right?
Yeah.
If it's clear, black and white on a piece of paper that says yes, you can do this, it's not a loophole. That's right. It's not. There's nothing creative about it. It's like, no, you can do this. That's right. So I feel like where the public gets kind of mixed up there is they think the tax code is only for the wealthy.
No, it isn't. It's for everybody.
Yes. And I will say, though, if you are a W-2 income earner and that's your sole source of income, there aren't as many roads that we can go down to help with taxes. It's pretty limited. But when you're a business owner, those highways open up pretty quickly, and then there's a lot of things that can start being done.
Yes, Freddie. So if you're a W-2 earner and you're single, there may not be a lot of pathways. But if you're a W-2 earner with a spouse that wants to start their own business or get into real estate, there could be some potential avenues to explore to reduce their tax liability.
Yes, especially that real estate professional one. That is like,
Yes.
that's like, I don't know. It's like a godsend. It's so available to everyone that has a non-working spouse, which is, I call it domestic engineer, but it's available to them, especially, and it can help out big time. And you're building wealth and you're saving on taxes and everybody seems to be winning. And the government wants you to do it.
That's right.
They want you to do it.
But let's take it a step further. Let's say the spouse says, I don't want to do real estate, but I want to buy a business or do something that they're passionate about, whether they want to be a writer, which I've had clients that want to be writers, and now they have successfully sold some scripts in the entertainment business. You could do that as well and still deduct your expenses as you're building out your library, literally your portfolio.
Yeah, the test is ordinary and necessary for the business. Those are the two words. That's like, I think the scary part is that it's so vague that it leads people to think it's like completely very strict. And in my experience, it actually is a pretty liberal two-pronged test. But also, people shouldn't like test the limits of it either.
Yeah, exactly, Freddie. Well, because we're not here to tell everybody to start a business and deduct a big loss. What we're saying is you have to have a business plan in place where whatever the dollars you're spending to invest in that business is to grow your business to profit. It's not to show a loss and to never land.
Right. It's called profit motive, by the way.
Profitability, right? Because we want profitability, so we could put 40 to 50,000 a year into a 401k, a solo 401k plan. We don't want to show losses. We want to show profits.
No, you want to make money.
We want to make money, a lot of it, so that way you can put into a solo 401k plan, potentially pay very little tax, and then that way you can invest that money that they put away on an annualized basis into other vehicles to keep growing the money.
Right. The more money you can keep in your life and keep that growing, the better, right? And but the tax code is set up for people to become wealthy, in my opinion. And every once in a while there's this, people talk about, oh, this is going to go away. Oh, this is going to away. Things aren't like just going to evaporate tomorrow. Like, recently with the step up in basis was talked about going away. I'm like, I don't think that's going away anytime soon.
Right. Right. That's a great question. Will the step up in basis go away? Let's talk to the audience here. What is a step up in basis? The Congress right now has a rule that's been around a long, long time that if a spouse passes away, depending upon the state you live in, or if an heir, someone like your grandfather passes away and you inherit a property, the government will reset the value of what grandpa paid for the property. So if grandpa bought the property for $50,000 30 years ago and today it's worth $500,000 and grandpa passes away today, the government will allow you to inherit that property and sell it the next day tax-free. If it was worth $500,000 and you sold it for $500,000, the government will allow you to sell that property you inherited from grandpa tax-free.
Tax-free.
But there's a caveat. In certain states, they still may have something called probate, right? If they don't have a living trust, or if grandpa did not set up a document to say, hey, I want this asset to go to this specific person. And for everyone listening to this podcast, it's important that I always recommend a living trust.
Yes.
To prevent those issues that could potentially come up.
You're a client of our firm, no matter what we're talking about, that living trust, because it it gets you, it basically eliminates probate. And it's private as well. It's private, So
Freddie, let me get this straight. So with your organization, since you've been in law enforcement for over 2 decades, you understand what the needs are for those families, right? And also you've established a practice to where you help folks with the right tax professionals,
right,
and to plan ahead, right, with their living trust, to make sure they have a living trust or that they have a tax plan and they plan ahead.
Or at least they know about it. My job is to educate, make sure they understand that these options are available to them, and trusts are not just for the uber rich. They're for everyone. and to, they're at least going to know all the rules of the game so they can make a good educated decision for themselves. Right. So, yeah, but it's not just for the ultra wealthy. And if people do these things correctly, they can find themselves in a lot better position.
That's very exciting. Well, your clients are in great hands with you.
Thanks. Appreciate it.
Thank you, Freddie. Excited to be here and excited to work with you and your clients.
Thank you. Likewise. Have a good day.
Thank you.